My simple two-fund portfolio has outperformed the S&P 500 every year for the past decade. And if you understand how hard it is to beat the market, then your first thought should be, no way, didn't happen, he's a liar. I think that's a reasonable reaction, but you will change your mind when I explain the process and show the year-by-year backtest results. We will build 3 passively managed two-fund portfolios that consistently outperform the S&P 500. I've seen a lot of videos on YouTube about the best growth ETFs lately, and they usually focus on the last 1 or 2 years of performance, so they don't give us the full picture. Let's zoom out, chill, and learn how these growth and value combos really work. If you're new to the channel, welcome. My name is Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please cannon strike that like button, subscribe if you haven't already, and drop me a comment down below with anything that comes to mind. We had 1 new channel member this week. A huge shout out to the one and only Anthony. And of course, a shout out to all of you that have been here all along. You'll see your name down on the ticker at the bottom of the screen. I hope you appreciate the perks, and I appreciate you. And I think this will be my last shout out for the big Black Friday sale on Seeking Alpha. If you're interested in premium, save yourself $90, support my channel, and dive into the best stock and ETF research tool with the link in the description below. You know what time it is. Let's grow. Beating the S&P 500. You're probably cringing at this section title if you've been around the investing game for a while now. And before you run away, just know that I understand how difficult it is to consistently beat the S&P 500. And more important than that, I understand why it's difficult. I've read 52 books in 2024 alone, mostly regarding this topic. I have a something is likely wrong with me level of understanding of this stuff. But my introduction was not exaggerated. There is a way to consistently beat the market. This is why about 90% of investors, not 100, fall short of the legendary index. But you will not outperform VU over the long haul with any of the following methods. Participation ribbon strategies, hand-picking winners, writing the hot market tips that you see online all the time or on TV, picking your stocks or ETFs based on single factors such as size, momentum, or value. ETF winner chasing, this is a huge one. Oftentimes, because of the reversion to the mean, yesterday's winners are tomorrow's losers. And then insert other gut and emotional madness here. We'll start off with what the S&P 500 is. And I'll try to keep this brief because I know most of you watching this video understand the market. I pulled up VU, the Vanguard S&P 500 ETF, out on Seeking Alpha, so we can see what the S&P 500 looks like. And the reason I use VU over SPY and a lot of the other ones is because it has a very low expense ratio of 3 basis points, and it has a ton of assets under management, over $1 trillion. The S&P 500 holds 500 of the largest companies in the United States, and it's often referred to at this point as the market. It's what everyone is trying to outperform. And you can see here from a sector breakdown, it's heavy in technology at 33%, but then it has a pretty nice balance of financials, healthcare, consumer cyclical, and communications, anywhere from 9 to 13%. And then industrials are 7.5%, consumer defensive is about 6%, and energy is about 3%. And one thing I like about the S&P 500, and right now it's fairly concentrated at the top, ironically, but usually, and even now, it only has a top 10 holding weighting of 35%. And you can see the 3 big boys, the 3 big companies are Apple, Nvidia, and Microsoft, and they're anywhere from 7 to 6%. But then Amazon, a behemoth, is 3.61, and it only goes down from there. Meta, Google, Berkshire, Broadcom, and Tesla to round off the top 10. But that's one thing I love about the S&P 500 is it gives you a little slice of the 500 biggest companies in the US. And now we're out on Morningstar because I wanted to show the most important aspect about the S&P 500 when it comes to trying to outperform it. It is extremely balanced by value and growth, and it has been for many years now. So this chart right here, of course, the S&P 500 is 500 large cap companies, so it's right at the top here. On the y-axis, it's all large, and you can see that here. That's what happens when you grab the 500 largest companies. But it's a little weird actually. I would expect a little growth
tilt. That's what it's been recently, but it's actually a little value tilt. So on the x-axis, if it's right here in the middle, it's 50 growth, 50 value. And historically, it's always somewhere right here. And that's why it's a good barometer of quote unquote the market, because it doesn't matter if it's growth or value popping off. It always holds a nice sampling of both, and it stays balanced and eliminates the timing, the market aspect, because you own everything as they grow and as they fall by their market capitalization. It'll automatically get rid of the duds and add the new ones that are added to the index. So it's a very powerful passive tool that is extremely hard to outperform. So the way we're going to outperform the S&P 500 is to break it down to two parts, value and growth. We want to find a value ETF that we feel pulls higher quality value companies than the value section of the S&P 500. And then same concept with growth. We want to find growth ETFs that pull higher quality growth sections. You know, this isn't one of those things where you buy 100% Bitcoin, you crush the market, and then announce that you're a genius. What we're trying to do is raise our floor and our ceiling a little bit to where we consistently beat the market in good and bad times.
It's time to upgrade that 50-50 growth value mix for the rest of this video. But before that, I need to make one final point to save us some time moving forward. You probably have one of two questions at this point, so let's cover both of them. Question 1, why not go growth heavy since it destroys value on the backtest? Answer number 1, please check out the last 100 years of the market's history. Question 2, why not go value heavy since we know it wins over the long haul and growth is way overpriced right now? Answer 2, please check out the last 40 years of the market's history. Okay, the real answer is you, me, and these guys right here have no idea what's going to happen next. The equal growth and value mix ensures that we trend in the same direction as the S&P 500. We want to focus on increasing the quality of both of these sections. So let's stop talking about it and do it. Why SCHD for value? It's no secret at this point that SCHD has had a rough past couple years when it comes to total returns. Many of its dividend peers are outpacing it over that time horizon. But when we zoom out, SCHD has been rock solid in the past. Now, past performance doesn't blah, 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 but it's the excellent methodology of SCHD that sets it apart. Instead of strictly assessing dividend growth like most of its peers, SCHD also puts an increased focus on the balance sheet. It ultimately selects 100 blue chip dividend stocks to represent the ETF. I won't go into all the details in this video since I cover SCHD all the time. But if you want to dive deeper, you can find all the information about the selection process by checking out the Dow Jones Dividend 100 Index, which is what SCHD seeks to replicate. Let's hop over to my screen to see what all this hype's about.
You can see I pulled up SCHD and I'm on the summary tab. The first thing I like to look at is that we get for 6 basis points of an expense ratio, this amazing methodology that screens out the 100 quality blue chip companies. And then the assets under management have just snowballed. It's almost up to $70 billion, which is good for liquidity's sake. And out on the holdings breakdown, I won't read off all these, but one thing I like about SCHD is it has 1, 2, 3, 4, 5, 6, 7 sectors in the double digits, and usually nothing above 20%. Right now, financials did sneak above 20. And the hard cap, I think, is 25. Normally, the top sector is about 17 or 18% just naturally with the screening process. So I love the balance. And then on the top 10 holdings, they're only about 40% of the overall fund, with the other 90 companies being 60%. Now, the thing we love most about SCHD is the dividend tab here. On the dividend scorecard, you can see that SCHD has a very solid 3.31% starting yield, but its growth rates is where it shines. In the trailing 12 months, it's up 12%, and then the 3-year compound annual growth rate is 9.5%. In the last 5 years, it's up an incredible 12% per year, and over the last 10 years, nothing fluky here, it's up 11% per year. This is as if you got an 11% raise at your job, or For you retired folks, this is what you compare to inflation to have your purchasing power persist in the future. And SCHD is just over 12 years old, and it has never once failed to pay more dividends than it did the year before. It has 12 consecutive years of dividend increases. Between the solid methodology, the balanced holdings, and the dividends, it's pretty incredible, but I have a little nugget for you regarding the total returns. I'm out here on the charting tab and I've pulled up total returns. Now I am going to admit that I have cherry-picked some data here, but what I cherry-picked was from SCHD's inception on 10/17/2011. That's when it started getting data. I went from that date all the way through 12/31/2022, over a decade. And you can see that before the last couple years, SCHD not only had those consistent dividends, it fairly significantly outperformed the S&P 500. So I just wanted to zoom out and provide a little perspective. We have had a growth bull run, which VU half benefits from, as we saw earlier, and SCHD really does not because it's high value, very low PE ratio in the last 2 years. And that's all everyone focuses on. So I just wanted to zoom out and provide this little nugget.
SCHD is easily my choice for the value section. Nothing else has come close for me over the years. Its worst year for total returns was negative 5.5%, which makes for an amazing stabilizer for the portfolio in bad times. And it has little to no overlap with the best growth ETFs that we are about to get into. Best growth ETFs. There are a few growth ETFs that we can pair with SCHD that will allow us to consistently outperform the S&P 500. I'm going to stick with the 3 that I would personally invest in. I think they're the best all-around growth ETFs out there. Again, there are plenty of winners, especially in this last decade. So feel free to throw the "what about this ETF" down in the comments below. I think the best growth ETFs to pair with SCHD are VGT, QQQM, and SCHG. First things first, it's time for more kudos for SCHD before we dive in. Check out these weighted overlaps.
I got this data from the Fund Overlap website. It's a cool site that you can plug into ETFs and it shows the weighted overlap, which is what matters. Remember, it doesn't matter how many companies they have that are the same. It's all about how much weight is in each company. So weighted overlap is what you want to be concerned with. So on the left here, you can see that SCHD has only a 3% weighted overlap with VGT, 6% overlap with QQQM, and a 0% overlap with SCHG. Whereas my favorite, probably all around dividend ETF, if I wasn't balancing anything, I could only hold one fund to make a hybrid, it would probably be DGRO. Lower starting yield, little lower growth, but solid all around. It has a 16% overlap with VGT, a 21% overlap with QQQM, and a 17% overlap with SCHG. Now, when growth crashes, this is really bad because 50% of your portfolio is already doomed, and that's where you need the floor of SCHD. And then another 20% or so also crashes and burns. SCHG is just a great counterpart for these 3 growth ETFs. And it hasn't mattered in the last decade plus because these growth ETFs are going to the moon, but that's not gonna last forever. So we shouldn't lose sight of balance.
VGT is my favorite of the pack, and this isn't based on past performance. It has been my go-to growth ETF for many years. As many of you know, I'm a huge tech bull. I believe in it now, but more importantly, I believe in the future of technology. I don't think any of us are smart enough to know what the next major breakthrough will be specifically, like semiconductors or AI of today, but I do think it will come from the technology sector. I like VGT because it pulls in over 300 small, mid, and large cap technology companies. And something like XLK, for example, will have a lot of weighted overlap with VGT because it also pulls in the technology sector, but it only pulls in the big boys. It usually has around 70 holdings or so. With technology specifically, I'm a huge believer in the up-and-comers. And then we have QQQM and SCHG. And these behemoths are direct competitors, and they're more similar than people realize.
We'll start here at the bottom of the screen with this note. SCHG and QQQM have a 60% weighted overlap. So we have a little bit of VU and VTI, not quite that extreme, or a VGT and an XLK going. These are very similar ETFs. And when you look at the top 10 holdings for SCHG and QQQM, you see mostly the same names at mostly the same spot. They vary a little bit, but one thing that I've always noticed, and it's actually not as extreme as it has been in the past, QQQM tends to have a little better balance in the top holdings. So usually its top 10 percentage is a decent amount lower. Right now it's only 2% lower actually, but its top big dogs, you can see here 8.83 for Nvidia, 8.52 for Apple, and 7.5 for Microsoft, compared to over 10 of Nvidia and Apple and over 9 for Microsoft. So SCHG tends to be a little more top heavy, and usually the top 2 or 3 companies are even more extreme over QQQM. So I personally have always liked the balance better of QQQM, even though it's only 100 companies compared to 230. And when you're saying which one has better balance or more diversity, it's debatable. You get the quantity with SCHG, but usually the better weighting, in my opinion, with QQQM. It depends on your preference, I guess. And then from a sector breakdown, you can see very similar, right around 50% technology, consumer cyclical and communication are flipped, but similar percentages. And healthcare is on both. QQQM has consumer defensive at 5, and then financials are 7, but really this is 91% and 92%. So you mostly have everything here, and they're mostly the same. So again, these are 60% identical, and really it comes down to your preference on the weighting side of things.
I added QQQM to my portfolio earlier this year, and I was on the fence between these two for many months. These are my 2 favorite multi-sector growth ETFs, and I don't think you could go wrong with picking either one of them or both of them. Let's hop over to Seeking Alpha to compare the metric that matters the most with these growth ETFs: total return.
We're right out to the good stuff here on the charting tab. I've pulled total return for VGT, QQQM, and SCHG. We're gonna start on year to date, which is almost the 1 year at this point. We're here on the 26th of November. Year to date, it looks like SCHG has been the champion here at nearly 34%. And VGT is coming in second place at 29, and QQQM is quite a bit behind at 25%. Might as well just quickly look at the year. It's more of the same. SCHG is the champion at nearly 40%, VGT at almost 37%, and QQQM bringing it up the caboose at 32%. Now we're here on the 3-year return, and we see that VGT takes the lead at 44%. SCHG is still a very solid second place at 40%, and QQQM, ouch, 33%. Now we're out on the 5-year, and I did have to replace QQQM with QQQ because QQQM is not 5 years old, but it is the same exact investment. QQQM just has a lower expense ratio than the Qs, but this works. You can see that VGT now has a solid lead in the 5-year at 176%. QQQ took over SCHG, but it's still close, 157 to 151. Now we're gonna zoom out 10 years, and you can see VGT has a commanding lead by well over 100% at 553%. QQQ is now crushing SCHG at 422, and SCHG is at 358%. And now to get the truest return, because more data is always good data, I've moved the time duration to SCHG, the newest of the threes, inception, which was 12/7/09. So you can see we're pulling 5,460 days for each of them. And here VGT has a very nice lead over the other two at 1,269%, and QQQ is right there at 1,211%. So a little bit behind VGT, but it's close. And SCHG has lagged by quite a bit at 893%. I always like to zoom out as far as possible when comparing like ETFs, just to get the most accurate long-term data.
It's time we settle the score once and for all. The winning mix with a 13-year backtest. This is the moment of truth. I've done a lot of talking in this one. Do these things actually work, or am I just making weird sounds with my mouth? We'll find out with the 13-year backtest. We will put each of our 3 combinations up against the S&P 500. Fight.
I'm out on Portfolio Visualizer, the master of doing backtests. And down here on the portfolio model configuration, we have 3 main portfolios. Let me scooch it down a little bit here. We have Portfolio 1, and it's 50% VGT, 50% SCHD. And then Portfolio 2 is the same thing with QQQ. Portfolio 3, same thing with SCHG. And then our competition is VU. And you can see the setup here. SCHD is in all of them. And then VGT, QQQ for number 2, and SCHG for number 3. And now here on the settings, we're going to pull as much data as we can. Really, it's just going to end up being from 2012 through 2024. Year to date, yes, so almost all of 24. We almost have 13 years of data now. Our initial amount's 10,000 and we'll contribute 1,000 per month. Rebalance annually, reinvest dividends, yes. Display income, yes. Let's go. You can see it is from January 1st, 2012 through November 25th, 2024. And this is just based on SCHD's age, so we couldn't look back further. Here is the performance summary, gives us our high-level metrics that matter. You can see that with VGT, the mix produces $607,000. QQQ and SCHD come up with $562,000. So not too bad. And then SCHG is another tier down at $530,000. And I see these are actually in perfect order because the market, what we're trying to outperform here, S&P 500, by creating quality growth and quality dividend to compete with its natural 50-50 mix of the two, ends at $482,000. So we did the job. We'll get into more return data down below. See, our best years are pretty close. VGT had a good one. The worst years are pretty close. Actually, VGT has the better one of those too. Drawdowns are similar, Sharpe ratio is similar. These are going to look fairly similar on paper as far as the 50-50 mixes. And then, S&P is a little lower on your risk reward ratios. And you can see here they all have an extremely high correlation to the benchmark, which is the S&P 500. This growth chart will drive that point even further. You can see blue is VGT, green is QQQ, gray is and teal is the benchmark. Look how these things go together. There's no such thing as a whoopsie or a home run like 100% Bitcoin or something that goes in the opposite direction. We are, for all intents and purposes, recreating the S&P 500 with our own version. And just to further drive home that point, here's the year-by-year returns with the same legend colors here. And you can see that every single year is very competitive and nothing ever completely outshines the other ones by too much. There's really no outlier extremes, even counting the market. But if you notice, the bars that are not the teal one tend to be higher most of the years, especially our blue one. That's my VGT mix, but you can see the market's down the most there. VGT's up the most there. See, good growth outperformance there. But even when we're down, when growth crashes, that's that SCHD floor, your value floor. We actually outperformed the market. All of them did in this down year. Again, it's very close, but we'll see how this adds up in the bottom. But the point of this chart here is to show that there's no such thing as like YOLO returns. Wow, our gut won the day. This is systematic dominance. Here are those trailing returns. So these are annualized returns. And over the full duration, you can see VGT had 17%, QQQ had 16.6, SCHG had 15.58, and the market had 14.62. Those seem to step down fairly well. And then over the last 10 years, a similar story on them. Really, it looks like that trend continues for the most part. SCHG is ahead of QQQ in the last 3 years, as you can see here. And then in the last year, as we established earlier, SCHD is number 1. But I feel like a lot of people are focusing strictly on this and year-to-date videos, and they're kind of neglecting the zoom out. Again, I think SCHG is great. It may be the best moving forward, but it's nice to just see the total picture. Here's some holding-based style analysis for these. And on this one, I'm just gonna skip right to the PE ratio. I wanna drive home that point that we're basically creating our own version from a mixed perspective of VU. Now this one's tech heavy, so there is some other risk with that, but the PE ratio is 27.4. And as we scroll down to QQQ, the PE ratio is 25.48, a little better value. And now the mix with SCHG is 26.84, right in between the two. And then our mix with VU, that growth value mix that the largest 500 companies naturally make up, is nearly 27. So it's the second highest PE ratio. That's the power of SCHD bringing the value floor up with these growth ETFs that swing for the fences a little bit. What a lot of people don't realize is VU is a big chunk of the fence swingers, and then naturally a chunk of some of the SCHD companies. So it's not as crazy to roll with your own mix compared to, again, shooting from the hip and making gut calls. That can get a little scary, but you're almost as stable as something like VU, as you've seen throughout this video, when you make a proper mix regarding value and growth.
There you have it. 3 simple portfolio mixes that have outperformed the S&P 500 for over a decade. I have personally used VGT and SCHD to get some nice outperformance. The small wins add up exponentially when you consider compound interest. Feel free to try any of these 3 combinations out or to make your own mix. But don't get too creative, because remember, over 90% of investors fall short of the market's return. Check out one of these 2 videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you here in the next one. Peace.